The government is open, 50-year mortgages, portable mortgages. We're going to get into that and so much more in the housing market update. Let's get moving. All right, the big three, we got prices. Prices are steady. Inventory is steady as well. Rates are flat. Really no movement at all. The headline news this week, hey, affordability. That is the headline. If you listen to any politician, either side of the aisle, they are talking about affordability. We're going to break this down. 50-year mortgage or portable mortgage? President Trump has talked about 50-year mortgages. That went off like a fart in church. And now we're talking about portable mortgages. You know what? We're throwing things against the wall. We're trying to get something to stick. But let's just lower rates. How about them apples? All right, the government is open and we need some data. We have a Fed meeting in December. We'll talk a little bit about that. And VA rates, not a lot to talk about there. They hover right around 6%. Millennials and Gen Z. Can we talk about the giant elephant sitting on your home buying dreams? Affordability. It's the number one reason so many of you feel totally locked out of the housing market. A new Scotsman Guide article calls today's housing market K-shaped, meaning some buyers are moving up while first-time buyers are sliding down. Repeat buyers have equity, investors have cash, and first-time buyers, you're getting squeezed harder than ever. And I see it every day. You're saving, you're budgeting, you're tracking rates like it's a second job, but prices keep rising. Down payments hit their highest level since 1989, and nearly 30% of home purchases this year were made by investors. It feels like showing up to a marathon while everyone else gets to start at mile 18. So what's driving all of this? Not enough affordable entry-level homes. Sellers sitting tight because they don't want to trade a 3% rate for a 6% rate. Investors buying single-family homes because the returns are strong. And wages, they didn't grow fast enough to keep up with home prices. That combination creates an affordability crisis that hits millennials and Gen Z the hardest. But here's the part no one tells you. You don't need to wait for the perfect market. You need the right strategy. And that starts with getting pre-approved early so you know your real buying power. Use low down payment programs, exploring overlooked neighborhoods or condo options, considering house hacking or using rental income, build in a monthly payment plan instead of chasing a price. I help first-time buyers do this every day, especially in markets where affordability feels impossible. So if the market feels unfair, overwhelming, or flat out impossible, you're not crazy. And you're not alone. Everyone's talking about the 50-year mortgage like it's the magic affordability button, but nobody's showing you the math. So let's compare a real $500,000 loan, 30-year versus 50-year, and what it actually means for your equity, especially if you're a VA buyer. At a 6% interest rate, here's how the monthly payments stack up. 30-year mortgage, $2,998 per month. 50-year mortgage, $2,632 per month. So yeah, you save about $366 per month on the 50-year mortgage. But here's the part that hurts. After the first 5 years of payments, the amount of principal you've actually paid down, 30-year mortgage, $34,728 in equity. 50-year mortgage, just $9,211 in equity. Let me say that again. The 50-year mortgage builds 75% less equity in the first 5 years. Now let's talk VA buyers, because this is where it really hits home. Most VA buyers have a VA funding fee, usually around 2.15 to 3.3%, which gets wrapped into the loan. So instead of a $500,000 loan, your loan might really be $510,000 to $516,500 on day one. With a 50-year mortgage, you're starting with a bigger balance because of the funding fee. You're paying it off much slower than a 30-year, and it may take years longer just to break even and start building real equity. In some cases, a 50-year VA borrower could own the home for 5+ years and barely reduce the principal at all. So here's the bottom line. A 50-year mortgage gives you a lower payment today, but you're sacrificing tens of thousands of dollars in early equity. And for VA buyers, you're stacking a funding fee on top of that slow amortization. Everybody's talking about portable mortgage, but it sounds like bullshit to me. All right, more portable mortgages right now. They are being talked about as a possible solution to affordability. But should we be excited or should we be worried? With home affordability at 40-year lows and the average age of the first-time homebuyer at 40, policymakers are looking at creative ways to help buyers without crashing the market. One idea on the table, the portable mortgage. Basically, instead of taking out a brand new mortgage every time you move, you take your old one with you. Here's the simplest way to think about it. You lock in a rate today, say 4%. You buy a new home later, even if rates are 7% or 8%. And instead of getting a new loan at the higher rate, you port your current mortgage and move it to the new property. Your rate stays the same, your terms stay the same, your payment stays the same. So why are people bringing this up now? Because homeowners are stuck. Millions have rates between 2% and 4%. And they're terrified of trading that for a 7% mortgage. Portability could unlock inventory by letting people move without giving up their golden rate mortgage. Here are the pros. You keep your low rate when you move. You avoid paying higher market rates. You skip certain fees and penalties. And it could help motivate sellers, which means more supply, which means more options for buyers. The cons only works if lenders and investors agree, which is complicated at the secondary market level. FHA, VA, conventional would require major rule change, and it could lock borrowers into older loan structures, and it may not work for jumbo loans or large move-up purchases. It doesn't fix the bigger issue, high home prices and higher rates. And here's the important part nobody is saying out loud. Portable mortgages are a creative idea, but they're not the ultimate solution. The administration may find that the simplest, cleanest, safest way to restore affordability isn't new risky loan products. It's lowering rates. In order for the Fed to cut rates, they need to see data, and during the shutdown, we didn't get any. Now that the government is open again, the big question is, when will the data finally drop? And will the Fed see it before the December meeting? The Fed can't cut rates based on vibes. They need proof inflation is trending down and that the job market is cooling. Without that evidence, they'll sit tight. But with the shutdown over, the floodgates are about to open. Here are the major reports the Fed is waiting for. Inflation reports, CPI, the Consumer Price Index, PPI, the Producer Price Index, and PCE, the Fed's favorite inflation gauge. Employment data, the BLS jobs report, the unemployment rate, wage growth, JOLTS job openings, and weekly jobless claims. These are the numbers that drive rate decisions, not headlines, not politics. So now that the government has reopened, here's the timeline. CPI, expected within 7 to 10 days. PPI, shortly after the CPI. Jobs report, typically 5 to 7 days after operations resume. JOLTS, next in the queue. And PCE, as usual, released at month end. Bottom line, the Fed will see all the key reports well before the December 16th and 17th meeting. But here's a real question. Will this data be soft enough for the Fed to cut? They want to see inflation steadily moving towards 2%, service inflation cooling, job growth slowing, not collapsing, and wages flattening out. If these come in soft, a cut is on the table. If they come in hot, the Fed is staying put. So yes, the Fed will absolutely have the data they need before December. Now it's just a matter of what the numbers say. Rate cut or not, this next month of data is going to tell the whole story. All right, taking a look at VA rates, we are steady right just above that 6% line. We probably won't see rates move too much until really the end of next week when we start getting some government, some labor reports coming out, maybe an inflation report, but don't expect a lot of movement until then. We're going to stay right around 6%. And again, these are not my rates specifically. These are the average VA rates across the country. All right, so what does this mean for buyers? Well, buyers, hey, we still are at the highest inventory level of homes in Oahu in the last 10 years. And our mortgages, I just locked a client today at a 4.75% interest rate on a 5/1 ARM. It was a half a point, clearly a half a point lower than a 30-year fixed rate mortgage. Gonna save this buyer a lot of money. To have a fixed rate mortgage for 5 years, they probably won't even own the home for 5 years, and they're going to have a lower mortgage payment, and then they can sell and move on. Remember, we're talking about location, 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 and everybody's a little different. The 5/1 ARM made a lot of sense for this couple. And with purchase application volume softening nationally, you may face, buyers, less competition locally, which is an opportunity to negotiate more favorable terms or ask for seller concessions. Rates have come down slightly, so if you're ready to buy, getting pre-approved now locks you in ahead of any rate uptick and gives you better clarity in this market. And given the affordability pressures we talked about, focus not just on the what you can buy, but the what you can afford and long term. Look at monthly payment, reserves, and scenario planning. Again, everybody's a little different. And if you're considering waiting for a big rate drop, know that while rates have improved, inventory and pricing in Oahu may not wait. You could see fewer options or rising prices the longer you wait. And for sellers, even though purchase applications are softening nationally, in Hawaii, supply remains constrained. We are really limited in our supply, although we're at 10-year highs. You still may be able to command a good price, especially if your property is well positioned with regards to location, condition, and pricing. With many rate-sensitive buyers, highlight affordability features of your listing. Maybe it's lower property taxes, maybe it's energy efficiency, and maybe it's move-in ready, turnkey. And be ready to show how the home compares favorably in monthly payment terms. That's where working with a lender will really help you out. And because refinancing remains strong, some owners may choose to stay in place rather than sell, meaning less turnover and potentially less competition for you. Capitalize on that by listing when your home is ready. And be realistic on pricing and concessions. Even though rates are trending downward, affordability remains a challenge. Work with your agent to set competitive pricing. Consider offering incentives, i.e. closing costs, flexible move-in, and ensure the home shows its value clearly. Hey, that's all I have for you this week. Have a great week and stay positive. Aloha.